Welcome to Listen to the Market for February 15. This will be a brief video in which I'm going to show and share with you the concept of knowing when to hold them, when to fold them, and when to roll them, with apologies to Willie Nelson. Let's start the day by doing what we always do, and that's simply having the three charts on the screen: the hourly chart for direction, the 30-minute for confluence, and the 50-minute for action stations. First things first, marking the previous day's low, marking the previous day's high on all time frames. Next step is to look at the previous day's daily bar to see what message there is for today's trading. Applying the L.I.V.E.T concept, there are a couple of messages of note for today. First one was to expect a larger range than yesterday, a larger range than Tuesday in other words, and expect lower lows. Right on cue in the idealized time window for the L.I.V.E.T setups to perform, there was a setup to sell on the 60-minute chart highlighted here. Entry point on the 60-minute chart being at that low, I sell at that high. The 30-minute, the chart of confluence, provided a sell setup also. Entry of the low there, I sell at the high there. Obviously, smaller range, lesser risk. Moving across to the 15-minute one, there was actually no edge in terms of taking the 15-minute sell setup, which was there, because the range is the same as the 30-minute range. So let's just focus on the 30-minute view then. And this sort of answers the question of yesterday as well. Next 30-minute bar comes along, no entry achieved, no break of the low, we still have a selling setup. The selling setup was triggered on the break of that low, the initial stop at the high of that bar. Two 30-minute bars are finished, which means 1 hour has transpired. Currently short, the message from the hourly chart is a promise of lower lows. All is well. The initial stop now gets lowered on the 30-minute chart from that high to the high and through there. Let's see what happened next. Next bar presents a lower high, enabling you to lower your stop to the high of that bar, or if you're using the top-down approach and rolling it back into a 60-minute campaign, the stop loss is above your entry point in through there. Let's see what happened in the two instances. Version 1, you get stopped out for about a 1 hour return. The market then continues slightly lower, next hour is complete, enables you to lower your stop in through there. Next 30-minute comes along, next 30-minute comes along. So clearly what you've seen is knowing when to hold them, when to fold them, and when to roll them really makes a difference between success in using the top-down approach and real success in terms of trading for mega R returns. As you can see, the hourly all the way through there has been making lower lows, lower highs, and finally being stopped out down through there, bearing in mind your initial entry on the 30-minute was way back up and through there. So a multi-R day. Thank you very much to the L.I.V.E.T setups and the L.I.V.E.T concepts in terms of knowing when to hold them, when to roll them, and when to fold them.